Good morning, students. Since due to the university circular, we are not able to continue with the lectures. So, for the remaining portion of management accounting, I will be sharing with you my video lectures. So, we were on the chapter working capital management, and during the classroom lectures, we had already talked about the meaning of working capital management, the concept of gross operating cycle and net operating cycle, and we had also covered the practical problems associated with estimation of working capital. We were only left with the theoretical questions of the chapter, the concepts which were related to working capital. So first theory question which I am going to cover in this first video is types of working capital. So there are four categories of working capital which we will be discussing in this tutorial. First is gross working capital and net working capital. Second is your temporary and permanent working capital. Third is balance sheet and cash working capital. And fourth is positive and negative working capital. So before moving on to the types, let us have a brush up of what is the meaning of working capital, and then I will discuss with you the types of working capital. So working capital basically means the difference between total current assets and total current liabilities. So what do you mean by current assets? As you all know, current assets are those assets which have to be converted into cash within a short period of time, which is generally 1 year. So say for example, if I talk about debtors, debtors obviously are realizable within a period of 1 year. So that is categorized into current assets. Then we have stock. Stock is also categorized as current assets. Why? Because it has to be saleable in a period of 1 year. Because if you extend the sales period, supposing if you are selling it after 1 year, it may be possible that the stock may become obsolete and is hardly saleable in the market. So current assets ideally means all those assets which could be converted into cash or which could be realized into cash within a short period of time. Second comes your current liabilities. So current liabilities mean all those liabilities which have to be paid in the form of cash in a short period of time, again which is less than 1 year. So if you talk about the creditors from whom you have purchased material, or if you talk about the outstanding payment of salaries or any other expense, all those expenses you need to pay within a period of 1 year. So now moving on to the types of working capital. First type of working capital is gross working capital and net working capital. What is the meaning of gross working capital? Gross working capital means the sum total of all your current assets. So say for example, if I see a closing balance sheet as on 31st March of any year or any other day, and I aggregate all the current assets, then that sum is called as total current assets, right? And total current assets, you call it technically as your gross working capital. Next comes your net working capital. Net working capital is the difference between total current assets and total current liabilities. So what is the difference between these two concepts? If you talk about gross working capital, I am only considering the quantity of my current assets. I am not seeing that from those current assets what liabilities I need to meet. And when I am talking about the concept of net working capital, I am talking about quantitative as well as qualitative aspect as well. So gross working capital means when you are considering only total current assets, and net working capital means when you are considering the difference between two. Second category of working capital is permanent working capital and temporary working capital. Permanent working capital means the minimum amount of working capital which should always be there with the organization. The word is permanent. Permanent means something which has to be already or always with the organization. So say for example, if an organization has initiated its business, right? So then to begin the operating cycle, they'll need the working capital. And once the operating cycle has begun, in that situation, to ensure that the cycle is rotating smoothly, they will need working capital. So that minimum working capital, which you also called as core working capital, which should always be there with the organization, that you call as permanent working capital. Next comes temporary working capital. Now the word temporary means which will be for a limited period of time, or the working capital which will be needed on a temporary basis. Now, what would be the reasons, possible reasons that an organization will require working capital over and above your permanent working capital? So, first reason is when an organization decides to temporarily increase their scale of operations. In that case, they will require additional working capital because they have started producing more. And second situation which may need the temporary working capital, that is in case of seasonal businesses. So say for example, if I talk about the woolen industry and see an organization which is into manufacturing woolen garments. So the demand for woolen garments increases when the winter season approaches in. So to meet the increased demand at that particular point of time, the organization will require higher working capitals because they may require to scale up their operations. So temporary working capital means which arises when an organization decides to scale up its operations, or when they decide that in case of seasonal businesses, to meet the increased demand, they obviously need to increase their production. So permanent means which is always there with the organization, and temporary working capital means which is there for a shorter period of time depending upon the temporary increased production requirements. Third is balance sheet working capital and your cash working capital. Now, when the working capital is calculated by considering the assets and liabilities on the date of closing balance sheet, which you generally do, so that you call as balance sheet working capital. So balance sheet working capital means the working capital which is calculated from the current assets and current liabilities as reflected in a closing balance sheet. Cash working capital. Now the concept of cash working capital requires certain adjustments in your balance sheet working capital. So what are those adjustments? Number one is that from your stock valuations, you need to remove non-cash expenses. So when I am talking about cash working capital, I need to make two adjustments. First adjustment is that from the valuation of stock, I need to remove all the expenses which are in non-cash basis. So the perfect example for non-cash expense which is there in the valuation of closing stock is your depreciation. And the second adjustment has to be made in debtors. In debtors, the profit margin has to be excluded. So when you make two types of changes in your balance sheet working capital, first type of change is in valuation of stocks, you need to remove the non-cash expenses, and in valuation of debtors, you need to remove your profit margin. So when you do these adjustments and calculate the amount of working capital, that you call as cash working capital. Next is the last concept of working capital is positive working capital and negative working capital. So positive working capital means when the difference between total current assets and total current liabilities is a positive value. So say for example, if I say current assets of the organization are 1 lakh and current liabilities are 50,000. So what is the difference? 50,000, which is a positive value. So we call it as a positive working capital. Negative working capital means when the difference between total current assets and total current liabilities will be a negative value. So if I say total current assets are 1 lakh and total current liabilities are 2 lakhs. So what is the difference? Negative 1 lakhs, which means that the organization has a negative working capital. Now if the organization has positive working capital, that means the short-term liquidity and solvency position of the company is good. But if the organization has negative working capital, the solvency and short-term liquidity is not satisfactory. So here in this tutorial, we have talked about 4 types of working capital: gross working capital, net working capital, permanent and temporary working capital, balance sheet and cash working capital, and last, positive and negative working capital.